Will Fed Chair Jerome Powell signal a bigger than expected rate cut? Let's ask Michael Landsberg of Landsberg, Bennett Private Wealth Management. I'm Lisa Bernhard with Reuters. Michael, markets are really focused on Fed Chair Jerome Powell's speech this Friday morning from the Economic Symposium in Jackson Hole, Wyoming. What will you be listening for in his language?
I think part of it, Lisa, gets back to are they still continuing to see what they've seen the last couple reports, which is slowing in the economy, but also this inflation number coming down slowly. So I think if we see that, it's kind of going as they plan. We can expect to see the rate cuts in September. What we don't want to see is him nervous and signaling there's a potential that they need to cut rates sooner. That's a much worse scenario for the market. Is an emergency rate cut or a sooner than expected rate cut? It's not what we want to see. We don't think we're going to see that. We think we're going to be in an environment where we're going to get probably 75 basis points worth of cuts between now and the end of the year. The big question is it 25 in September or 50?
So what is really the difference between a 25 or 50 basis point rate cut in September, other than the size? I mean, what's really the effect of that? Is one more symbolic than the other, or what do you think?
I think what the market may take from that, and really it's two answers. I think politically, it may be difficult to do a 50 basis point cut in September with a close election, because I think one candidate's going to say that you're helping the other one out. So I think there's a political kind of overhang on going 50. But I think 25 indicates that, okay, this is how things are going and we're going to be slow and steady. I think we probably get the 25, but I'm not throwing out the idea that 50 comes into play. If you're getting 50, maybe things are not quite as rosy as we've been led to believe. I think that's also something the market could read in. So I think 25, the market would enjoy that. 50, I think the idea would be, hey, we're getting there faster. But the idea that we've got to cut rates more than we need to is not necessarily something that the market's going to, after a day or two, think is going to be a good thing. Because I think they're going to worry that, okay, what do they know that we don't know?
Interesting. Okay, speaking of getting political, we are now in the midst of the Democratic National Convention. And, a few weeks ago when we saw the assassination attempt on President Trump, the markets rallied and the so-called Trump trade was in full effect. Now that we know a bit more about Kamala Harris's policies, is there a Harris trade? What is on the mind of investors right now?
Yeah, I don't know if there's exactly a Harris trade. I think a lot of what Democrats in the past have done, whether it's the Biden campaign, is things that have traded in that space. Typically, some of the alternative energy, some of those things that are there, I think might benefit from there. The kind of riding situation that we've seen is if they're raising taxes, that's not necessarily good for corporate earnings. And if you're looking at price controls, that's another thing that's not great for corporate earnings. So I think broadly a Harris trade is less stocks. And then could you look at some sectors? You could, but I think the broadening scenario here would be some of what's been suggested so far is not necessarily positive for stocks. We know this is just election trail talk, but obviously taxes going up on corporations and price controls are not necessarily something that's strong. Again, some of the areas that Democrats have favored in the past, I think you could make the argument that alternative energy and things like that, those green energy, that could be back in the mix after having basically been abandoned for the last year or so in terms of stock performance.
Stocks have been on a tear recently after the big sell-off that we saw in the week before last. Assuming there's more volatility coming up for a variety of factors, including geopolitical. What's your advice right now in terms of what you're buying, what you're selling? What do you think?
I think when we look at things, obviously, tech's done very well, and most investors are sitting on big gains in tech. They probably have a lot higher allocation to tech now than they did at the beginning of the year. So those are the opportunities we look at to kind of resize or right size our tech exposure and look to add to areas that maybe have underperformed or at least are not as sensitive to the moves of AI. What we've seen when people talk about diversification is they'll say, well, we own utilities, we own industrials, but they're all AI plays. And I think that's not really diversification. That's kind of basically a classic AI sector play. So for us, I'd like to own some real utilities. I think it'll benefit from lower rates. Real estate's another area that we like. Again, not a data center play, but other things besides that kind of real estate. And healthcare and staples. We think those are continual things that will do well. They've got earnings growth, but they're not priced to perfection like some parts of the tech market.